Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is VideoCast, episode 99, podcast episode 89 for the week ending September 10th, 2021. I'd like to briefly touch on the media spots, and then we're going to get right to it this week. We've got a lot to cover. First off, I'd like to thank Shauna Smith, Taylor Clothier, and Josh Schaefer for having me on Yahoo Finance on Tuesday. We're going to go into that in great detail later in the podcast, VideoCast, as it relates to taper, as it relates to yields, and a lot of good stuff. But let's move right along for now. Also want to thank Lydia Moynihan over at the New York Post, favorite paper and favorite business writer over there. She's doing a great job. She came over from Fox Business, and her article, you can click here to see it right at the New York Post, was about the airline stocks. And what I was talking to her about was that the high quality ones like United Airline and Southwest were both down 25% in the last 2 months on the Delta news and on expectations of them taking down bookings, etc. Well, yesterday, a number of them came out and said we expect bookings to be lower in the short term due to Delta, and it seems like that may have been the bottom. It looks like it was a sell the rumor, buy the news, and we'll see if we get follow through next week, but I think this whole reopening trade moving forward is going to be a huge opportunity, and we'll explain why in great detail. So my quote to Lydia was, several states have already peaked on the Delta variant, and when the aggregate numbers fall, we're going to see a tsunami of bookings. Tom Hayes, chairman and managing member of Great Hill Capital, told the Post. Business travel will come back shortly after offices are filled again, he said, pegging the first quarter of next year as the time to look for a resurgence. So just as these stocks started to discount the slowdown of Delta 2.5 months ago, they'll start to discount the ramp up in Q1 in coming days and weeks if they haven't put it in their bottom yet. So I thought the timeliness of the article was incredible. I think New York Post is probably one of the most underrated papers in the country. It's one of my favorites. It's my go-to first. Obviously, Barron's, Wall Street Journal, Financial Times. I read that for the hard business stuff, but the Post really puts out a lot of good stuff, and there are a lot of fun articles in it as well. So there you go. We're going to start with a quote from John Templeton. If you want to have a better performance than the crowd, you must do things differently from the crowd. And, I think this is appropriate because we're going to go through, we've kind of had this period where we got off to a rocket ship start this year with the reopening trade in Q1 and Q2, and then just kind of plateauing over the summer, some bumps with China, etc. And, I took the long weekend to go through client portfolios as well as my own. And the common denominator was there is, you look at the general indices and you say, my goodness, it seems like they've just gone straight up without stopping. And then you look under the surface and it's just unreal, some of the opportunities that are out there, some of the discounts that are out there, and how, a handful of stocks have kind of held up the indices. We'll see if that continues with Apple. Apple, a couple of things happening with Apple. Number one, they had the ruling today about Epic Games that developers could have people pay outside the Apple store, which I think in the short term, all the analysts came out defending it. There were like 4 or 5 analysts. It won't be a big deal, blah, blah, blah. But, the entire growth story is predicated upon it. So we'll see how it shakes out. Obviously, there are going to be appeals. Apple's going to appeal it. It will be delayed. Implementation will be a year out. But we have to see whether the multiple is justified. Obviously, Apple's an incredible business. It's always going to be a great business. But that growth, that App Store revenue, that 30% VIG was a huge part of the growth story. And I think today was a bit of a surprise. I think Apple was down 3 or 4%. But more than that, its impact on the general indices is going to be interesting because, I look at the indices and it's just like, man, this thing has to take a breather. But then I look under the surface at all the stocks that are just beaten up over the summer, and incredible values, high quality stocks. I'm not talking small caps and, smaller mid caps. I'm talking about some of the large cap, high quality businesses that are just down, 30%, et cetera, that are just set up to have a roaring rip back. And as I looked at the intrinsic value, I mean, not just the companies we own, but some of the options that we own, deep in the money options on some of these higher quality, lower volatility stocks that we could get implied volatility at a very reasonable price. I mean, I could easily see, 80, 90% moves out of these, not overnight, but over the next 6 to 9 months, and before the end of the year, 30, 40%, you cut it in half. And I'm looking at it as they're just doing nothing the last couple of weeks. Obviously, the Dow and the S&P have been down every day, and, it's that time of year. But when these things turn, so we're going to look at, what could be the possible catalysts for some of the reopening trades coming back, and some of those sectors and groups that have been kind of forgotten over, in some cases, in the case of small caps, over the last 8 months, and in the case of, or 7 months, and the case of the reopening trade in the last 5 months, they haven't done anything. And what could be the spark that lights the fire and has a huge year end and into the first quarter. So we'll look at some of that. So you've got, as far as the general market goes, you had a bunch of banks come out this week, negative, opinion follows trend. The market was down, 5 or 6 days. So everyone gets a little bit bearish. And, but if you step back, this is Goldman Sachs. GDP for this year is still going to be over 6% consensus. And then next year, close to 4.75. So these are numbers we haven't printed in a long, long time. Obviously, the growth rate will slow off a higher bar than, last year was a very low bar. And keep in mind that probably excludes a large assumption about the amount of the stimulus package coming forward, which, will probably be in the neighborhood. You've got the infrastructure, $500 billion to $1 trillion, and then you've got the social spending package, somewhere between 2 and 3 trillion would be my guess. I know Manchin came out and said he'll only support 1.5. That probably means he wants a couple more bridges, roads, and schools in his state, and he'll get there. But they know that they've got this limited window of opportunity that's closing, where they basically have carte blanche through reconciliation, and it's now or never. So my bet's that they push something big through. And in the short term, it will be stimulative. In the long term, we'll have to figure out how it gets paid for and what it does to debt to GDP and all the other things that are being debated. But there's just a lot of gas in the tank right now. Okay, want to get to the questions of the week. And a good one came from Marcus Dorman, and he made a note that, and this is something that I've done, and for those of you running smaller accounts and using put spreads and call spreads, maybe you remember the trade service, he made a point. So I want to take Cigna as an example, and this one looks a lot like Splunk did before it took off, by the way. Let's see how Splunk is doing. Yeah, so Splunk is up 11 months. Okay, so Splunk keeps working its way up. So if you remember, we were pitching Splunk down here, started to rally, then after earnings, it sold off huge. We were saying buy, and adding to the position, and then it just took off and it's continued to work its way off. We think it's got a little more juice, and then we'll start peeling some off. But I want to go through this example with Cigna, because Cigna is a similar example. Cigna sold off on the increase of the medical care ratio shot up from 80 to 85% in the last quarter's earnings due to COVID costs, COVID testing and COVID service. But the large part of their business, the Evernorth, which is the pharmacy business, script volumes were up 13% now that people are going back to their doctors. And it's trading at 9.5 times next year's earnings versus its historic multiple of 12 times. So we think it's a huge opportunity. So today, some analyst came out from Bank of America and downgraded the stock, so it sold off. Now, he didn't downgrade it up here at 270 when he was bullish. Now that it's down, 30%, give or take, yeah, okay, so more than 30%, right around 30%. Now he comes out and downgrades and he says, well, the medical care ratio, we don't have any visibility. Well, no one has any visibility. You tell me what Delta is going to do. I'm going to tell you what the market's going to do. I am optimistic about Delta. I'm going to show you some numbers that make me optimistic about Delta. And a lot of our assumptions in terms of the intrinsic value playing out in our portfolio holdings of 80 to 90% and, cut that in half, in the shorter term, are predicated on, Delta starting to wind down. Now, you could say, well, no, the kids are going back to school. They're going to bring it home, da, 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 da. I can't control that. What I can control is buying high-quality businesses when they're tremendously discounted relative to historic multiples and prospects moving forward. So in the case of Cigna, so let's say, so now it's sold off. We originally started pitching it here, and it's just kind of gone sideways for the last 4 or 5 weeks, and then it was starting to break out, and all of a sudden this analyst comes out again after it's down 30%, not up here when it was at 270, back when it's down at close to 200. He downgrades it, the stock sells off 4%, and you say, okay, I buy Tom's story. I think Cigna is going to work its way towards new highs over the next handful of months. And I want to buy the in-the-money 195-200 call spread, okay? So I pulled up these numbers at 3 o'clock today, and you could buy that spread, that $5, for $3.05, okay? So basically, it would be like buying a $30 stock that goes to, or a $30.50 stock that goes to $50 if it closes anywhere above 200 for January. So this would be the January month, 195-200. You buy it for $3.05, and if it closes anywhere above 200 in January, you make $3.05 becomes $5. So it's like a $30 stock going to $50 stock. You nearly double your money. So that's a good thing for 3 months. Everyone agrees with that. This is not some kind of stock where, it's some high-flying stock like Zoom, and if it misses expectations because it's trading at 75 times sales, it's going to be down 40% in a day. We don't have that kind of risk. We kind of know what we're dealing with here. Now, the point that Marcus was getting to is, what if it goes against you first? And this is something that I've been doing many times over the years that I think some of you might find valuable. Because the key when you buy these spreads is people make a lot of mistakes. The number one mistake they make when buying options is they buy too short of dating, and they just lose because of time, even if they're right on the idea. The second thing is they buy, dramatically out of the money, and then if it goes against them first, and then you lose time to make it back, and that can be a problem. And that's just part of the game. The key is not avoiding risk, it's managing risk. But let's say you're in this spread at 195-200 for $3.05, and it moves against you. Now, how did they get to the $3.05? You bought the 195 call, the January 195 call, for $19.50 a contract, and then the 200 you sold for $16.45. So you bought for $19.50, you sold for $16.45. The net cost to you is $3.05. So what could happen between now and January, whatever it is, 18th or whenever it expires, is that you could get another downgrade. You could get the administration come out and say, health insurance costs are too high or drug costs are too high. We are going to crack down now, and this thing could shoot down to 190. Now, it shoots down to 190. That spread is probably like down to $1. It's down to 50 cents. Who knows? Maybe it shoots to 185 short term. You just get a series of downgrades. All the analysts pile on. The administration says, no one's going to pay for drugs anymore. The drug companies just have to give them away for free. The insurance companies should cover everyone for free. No one makes a profit. So something bananas like that. So in most cases, that would just be negative. If you own the stock, it's not a good thing. If you have high conviction, you'd probably add to the stock, obviously. If you had long dated options, if you just had long call options, maybe you'd add. But it's more money out of pocket. So the opportunity when a spread moves against you in the short term is that short option that you sold at 16.45. If the stock dropped down to 190 or 185, that might go, depending how close you are to January, that option might go down to $4 or $3 that you paid $16 for. And what you could do at that point is, rather than say, I got to blow out of the spread, I better take my $1 or my 50 cents, I paid $3.05 for it, is you just buy in the short leg. So the one that you sold for $16.45, you could effectively buy in, for $2, $3, $4, $5, whatever, a third or a quarter of what you sold it for. And then you're out of that trade, and all you have left is the long option. So rather than being capped at, $3 becoming $5 or $3.05 becoming $5, close to a double, or, less than a double, but you get the point. That long call now becomes unlimited upside because you're not capped by the short call that you sold against the long call to get the cheap price. So if you were just going long at 195, if you were just buying the long dated calls, you would have had to come out of pocket, $19 a contract, $19.50 a contract. So you're talking, $1,950 each contract, because it's 100 shares per contract. But instead, you're coming out 305 for an expected, 75% gain or whatever it happens to be at expiration. Here, you use the negative scenario in your favor, where you would buy in that short call at, 10, 20, 30, 35% of what you paid, what you sold it for, and then you get a free ride on that long call. So effectively, the long call that would have cost you $19.50, now you're in, maybe 305 plus, if you bought back the $16 one for $4 or $3, you effectively have that 195 call now for $7, when it would have cost you $19.50 straight out of the gate. So it's basically turning lemons into lemonades, and that's why we tend to buy more time on these type of spreads in the service than most, because it gives us the optionality to not have to be perfect on the bottom, just buy enough time that if it does exactly what we want right away, that's great. And if it doesn't, we can actually increase our upside by taking out the short leg that moves against us. So it's a little higher level stuff. I'm glad Marcus brought it up. It's a little more complex, so we don't cover that a lot, but I thought it was worth bringing up on this call, and I appreciate the Ask Me Anything question. Second Ask Me Anything question is Ben first name only. Hi Tom, why is defense and aerospace drastically lagging almost all other sectors? Okay, this is the question du jour, because this is the theme of the entire call. Let's get to it. Here are some defense stocks, large cap aerospace and defense. And what you're going to see with the defense and aerospace is, they've had a nice run here, but some of them have rolled off. When? In the last 2.5 months. So the ones that have more exposure to airplanes have sold off in concert with air carriers that have also sold off on the Delta fears over the last 2.5 months, 3 months. Because if you remember, Delta was huge in UK and India before they rolled over 50 days into it. So the markets have been discounting this, and the heavy weights in the ITA ETF, which is defense and aerospace or defense, happen to have big aerospace as well as defense, but big aerospace exposure, like Boeing is a big weight, like Lockheed Martin is a big weight, like HEICO, and some of these others. So, we obviously love Lockheed here. We love Boeing here. General Dynamics, if you remember, in the beginning of the year, January 4th, was one of our top 4 picks for the year. That's up huge. That has less exposure to the aerospace. That's why that hasn't rolled over, and it also has a lower weight. Same thing with Raytheon, hasn't rolled over as much. That has a different weight. So Lockheed Martin, HEICO, Boeing, heavy weights in the defense and aerospace, but heavy aerospace exposure. And we do think, as we said in Lydia Moynihan's article, and on Shauna Smith, Yahoo Finance with Shauna Smith, is that we do think that some of these airlines, the highest quality, even some of the cruises, have a huge opportunity, and this short-term Delta spike is creating a huge opportunity moving forward. So why is defense and aerospace lagging? It's because of its exposure to aerospace. And you look at all the carriers here. United here down 25% in the last few months. You could basically overlay Southwest, the highest quality. You could overlay their charts with the defense and aerospace that have huge aerospace exposure. They look exactly the same. So that answers your question. What solves that problem? Well, take a look at this. This is COVID cases. Okay, so the 7-day average is rolling over. You can see here. Whether we get one more spike up like we saw in December, we don't know, or we just roll over like we saw in last September, it looks like July through September. Who knows? But the more this rolls over, the more these stocks are going to bottom and start to rip higher. Because just as the bookings were slowing in anticipation of Delta, there's going to be a tsunami of bookings once this number rolls over. Everyone's going to want to get ahead of the pack to book and to get decent deals. Because if you wait until this 7-day moving average is down here, you'll be lucky if you get a seat, number one, and number two, you'll be paying triple the people that start buying up here. So all of these are going to move together: defense and aerospace, the high quality carriers, and I think that's a huge opportunity. I think these Boeings and Lockheeds look exactly like what we just laid out with the Cigna idea, where you can get these things on the cheap, high quality, lower volatility, and really benefit moving forward. We did skip ahead. What's your feeling on QQQ in the short term? We're going to cover a lot on rates. I would say, as I said on Shauna's show, which we'll get into, it's nuanced. There are selective opportunities in tech. Two of the names that we've been talking about the last 4 weeks have done quite well: Amazon and Netflix, because they had done nothing for 12 months and they started to take off. I do think that we're moving towards an environment where as this rolls over, rates are going to start to move up, and the reopening trade is going to start to come back. And all these stocks that have been left for dead over the summer, that had summer swoons, are going to just take off. And the tech stocks that have run hard since June, when we were talking about rates compressing and tech getting a bid, I think some of those are going to start to soften up. And Apple may be the first. We'll see. Not only do they have this Epic thing that will be obviously appealed, but their big event is September, and every manager knows generally the play over the last decade has been to buy the event and then sell the news. So they have double pressure after this week. And my guess is what they'll do to offset both of those headwinds is, one, buy back stock, and two, probably, maybe make some type of big announcement about TV or the car, just to keep everyone excited about keeping that multiple up. Whether it'll work or not is going to be a function of how the market digests the impact to the App Store after they've had a couple weeks. Because right now they're doing their knee-jerk defending the stock because they're all, Uber buys, Uber overweight on the stock. All they can do is defend it in a knee-jerk reaction. After they digest what it can mean to the growth story and to their bottom line, because while it's a small percentage of top line, it's a big percentage of bottom line, that remains to be seen. So that could have a weight on the tech sector overall. Rates will be the most important thing to impact the tech sector. So I think you have to be very selective. I think, the Splunks of the world, especially discrete. I think Intel's, maybe Amazon and Netflix have a little more juice in them. They've had a big run in the last 4 weeks. But I wouldn't go overboard with new money at this stage on those stocks. And we'll get into it. So am I short on anything? No, not with this liquidity. But that's probably not where I want to be focused on in coming weeks and months in terms of adding new stuff. If there are discrete opportunities like an Intel, some stock that's gotten beaten down, and I can make a case to why it should revert to its mean over time, I'll take a look, but that's not going to be an area of priority at the moment. Okay, Tim Good says, you've been very transparent with sharing how you seek value for a good price, so clearly you do not chase the popular stocks. Curious if you pay attention to triple, quadruple witching dates to buy into, or is that just noise? That's just noise. You've consistently said to look under the surface for opportunity. I mean, it's noise, like it's supposed to have a negative implication. If you find a good quality company that's on sale and you think it's going materially higher in the next 6 to, don't wait for quadruple witching. It's like you could get a new headline every day of the week that moves the stock. So I wouldn't pay any attention to that. You've consistently said to look under the surface for opportunity and not to focus on indices. Curious if you consider an ETF like XLF, XLE the same as an index. Thank you for breaking these down. By the way, your earnings, with your earnings target summary, super helpful. I do consider those kind of the same as an index. I'll use the sector ETFs if I just want to get quick exposure right away and then figure out later where's the best value per dollar. So that's how I would think about that. I use ETFs more as a placeholder than as where I want to have my long-term exposure, because there's no real value add in that. From my perspective, I can understand if you want to be in a sector like energy's down, but I would drill down personally on individual stocks. Obviously, I don't know what anyone's individual situation is. Talk to your financial advisor. Go to hedgefundtips.com and click on terms. This is opinion, not advice. But I don't find huge value just holding the ETFs if I can help it. With the anticipated uptrend in the 10-year yield, do you think utilities will take a breather? This is a good question, because I do think we're setting up for rate rises before the end of the year. I just don't know if we get a head fake first. So, when I look at okay, so what's this? So this is utilities. All right, we did the defense. We did the airlines. Okay, this is utilities. And when you look at these, they've had big runs off of where we put out our first note at the last week of February, first week of March. So they have had these big runs. And if rates are going to go up dramatically and quickly, utilities is not the place you want to be. But at the same time, let's zoom out a little bit. I just feel like these have a bit more runway. I mean, they've barely even recovered, most of them, from the pandemic. I mean, they've had these big bounces since February, but they haven't moved. So I don't have a perfect answer for you. What I would say is, if you have profits on some of these positions, on up days, I'd start to shave a little bit off, but I want to keep some of this on through year end, even though rates should be moving in the upward direction. We're going to talk about why. So, like Dominion, I think this has more room to run. Same with American Electric Power. I think these have more room to run. But you're right. If rates are going up, do you want to hold these? So you don't want to be overweight. If you've had some profits, on up days, you could take some, but I do think these have another leg, which would be consistent with maybe a head fake in treasuries in the short term, meaning, maybe you get one last move down in yields before we get the move up towards 2%, towards Q1. That's how I'm thinking about it, but it's an astute question. It's the right question, and it's one I've been grappling with for a number of weeks and how to think about this moving forward. But I do think some of these have have some more juice in them to the upside. So good question on that. And then finally, thoughts on high yield commodity stocks like Rio and BHP, Rio Tinto and BHP Billiton. Both are down 10 to 15%, and they pay you a high dividend while you wait. I've looked at both of them. I understand where you're coming from. I couldn't get comfortable with them. So I've always, common equities that yield over 5%, there's usually a red flag there. And the other thing that we're going to talk about is the China credit impulse chart in just a moment. And there's a correlation to kind of metals and mining. And I've just never loved miners generally. They just have this uncanny ability to consistently lose money even in good environments. It's like they have to work 24 hours a day to lose that amount of money that consistently throughout cycles. And there are exceptions. Obviously, they had a big run in the emerging markets, run in the early 2000s, and we could be setting up for that. But these things have had a decent run off the bottom. So I'm going to just say I'm agnostic on those. I just think they're better risk rewards than those stocks right now. Okay, so let's move along here. We've got a lot of different stuff. Let's talk a little bit about the general market. Macro Charts on Twitter posted this. I like this article because this week, a ton of banks, obviously after the market being down a number of days in a row. And where did we end this week? It was... Oh, here it is. Okay. For the week, the Dow slid 2.2% and is down for 2 consecutive weeks. The S&P lost 1.7% this week, its longest losing streak since February 22nd, 2021, when the market fell for 5 straight days, and the Nasdaq declined 1.6% this week, the largest one-week percentage decline since July 16, 2021, according to FactSet. So the 6 largest Wall Street banks issue red alerts. Morgan Stanley, Bank of America, Deutsche Bank, Citigroup, Credit Suisse, and Goldman Sachs. Red alert warnings with some expecting an imminent correction of 10 to 20%, while others expect a slow burning drift lower over the next few months. Below, we summarize the highlights for their downbeat views. And Macro Charts put this out. He said, everyone has a foot out the door. Bob Farrell's rule number 9. Bob Farrell was a famous chartist. And he said, quote, when all experts and forecasts agree something else is going to happen. And then he says, let's look back in a few months and see what happened. I agree with him here. The idea of a 20% correction is kind of ridiculous in the sense that in order to get a 20% correction, you need a recession. And in order to get a recession, you generally need a yield curve inversion 6 months before that happens. and we're nowhere near a yield curve inversion, and we'll talk about that as we get into the article of the week. On the flip side, UBS, which is usually the most negative bank on the street, all the European banks are usually the negative. SocGen, BNP, and UBS are frequently the most negative. Now they're positive, and they said S&P has more room to run into year end. And these are the 5 reasons: a 10% plus rise in forward earnings over the next 6 months. That's been our base case. We'll talk about that in the article of the week. An eventual fall of COVID cases, agree. Still strong growth activity. U.S. GDP growth is still set to be more than 5% for the next 3 quarters, agreed. Much more fiscal spend than taxes. Fiscal spend of more than $2 trillion is not fully priced. Upside for select cyclicals. We agree with that. And then finally, the ability to absorb a 30 to 50 basis point rise in real yields. I agree with that as well. Every 50 basis point rise in the 10-year yield is a 3% headwind to the PE ratio. But our work shows the S&P can absorb 30 to 50 basis point rise in rates as equities didn't re-rate up as yields fell in the summer. That's a good point. So yields fell dramatically. The multiple didn't go up because earnings went up. So they're making the counter argument. I tend to agree with that. Equity internals are also pricing higher rates with a likely greater catch-up for stocks, positive geared to higher rates than a catch-down for stocks hurt. I agree, and that's the basis of our argument in this for the reopening trade, which we're going to move on to shortly. Ryan Dietrich put out this chart I thought was great. He said, would you believe this bull market is actually young? It has been anything but average so far, but the average bull market lasts about 5 years. This one isn't even 18 months old yet, and it shows the longest bull markets post-World War II. And the average is 64.5 months. We are at month 17, and you see some of these get into the 200, 300, and 400% by the time they finally have a 20% correction. So that's Ryan Dietrich over at LPL. All right, we've covered this. We've covered COVID. Okay, now I want to cover 3 things, 2 charts that we covered last week. This was cheap enough. Valuation gauge, 20 years low, favors small cap U.S. stocks. This is from Luthold Group. So it talks about the small cap forward PE ratio relative to the S&P 500. It hasn't been this low since 2001. And if you recall, from 2001 to 2005, small caps had basically their best period ever. And we're setting up kind of right at that thing, and that's why we talked about small caps last week. We also did Russell small. We usually cover earnings at the end of the call. We're going to cover it right now. We took the top 30 weights of the Russell 2000, which is the small cap ETF, and the cumulative 2021 earnings power of these 30 stocks increased by 11.8% in the last 60 days. The cumulative 2022 earnings power of these 30 stocks increased by 8.8%, 8.6% in the last 60 days. Okay, so earnings power has increased. What's happened to price? Price has done nothing since February. It's just been in this range, and our bet is whether it goes to the bottom of the range first or not. We think this is eventually going to break out and form a continuation pattern. So that's that. The second one we covered was emerging market stocks. This was from Bank of America Global Research, approaching 20-year lows versus the S&P. So you've got small caps relative to the S&P at historic lows, similar to that 2001 period, by the way. The bottom was 9/11. That is really strange. Okay, so nonetheless, 9/11 is tomorrow. So that was the bottom for emerging market stocks relative to the S&P 500. Whether tomorrow will be the bottom for the emerging markets relative to the S&P 500 remains to be seen. But the same thing was for small caps. So that is uncanny. We'll see if history rhymes. May not repeat exactly, but it may certainly rhyme. Look here. That looks like right around September 11th, 2001 as well. Small caps and emerging markets both bottomed on that day, which is really interesting. Okay, the other component of the reopening trade has also basically gone nowhere since April. So for 5 months, it's basically gone sideways as well. And that's what we were talking about. Looking at the portfolios this weekend, monster Q1 and Q2, and then just sideways chop. We think we're setting up for a resurgence of the reopening, and we're positioned for it as well with some hedges. Obviously, China is uncorrelated, so we like that. We're going to talk a little bit about that right now. And then if you look at the PMO, we talk about the PMO by all sometimes. We talk about the PMO S&P 500. Today we're looking at the PMO Dow Jones Industrial Average, and that's closer to where you want to be adding exposure versus selling exposure. That this is where you want to add at the bottom, add at the bottom, add at the bottom, add at the bottom, add at the bottom. So we're closer to where you want to be buying than when you want to be selling, which is also consistent with how things are setting up. And then this is the 10-year yield. And you see it creeping up. It bottomed in August at 113 basis points. It closed the week at about 134. So it looks like it's working up. We're going to spend a lot more time on this in the next few minutes. Now, I talked about China credit impulse as it related to BHP and Rio Tinto. The one thing, so I originally got the idea for the credit impulse from Tiho BKHAN, TIHO BRKAN, TIHO BRKAN on Twitter. Tiho put this chart out there, China credit impulse. And what he's basically saying here is that as that credit impulse bottoms, so do Chinese equities. Now, what is the credit impulse? So this according to Bloomberg, measures the growth in new financing as a share of gross domestic product as an indicator of business cycles. China's property developers, manufacturers, and local governments depend on new credit for an investment, driving up employment and demand for imports of industrial goods and commodities. So, what you see in this chart, and this one's a little bit better by at Themistocles, Themostocles. I found him just by searching for China credit impulse charts. And what you see here is, late 2014, late 2011, and late 2018 when the credit impulse bottomed, and we're right in that range now. Now, what happened during these periods? So, early 2012, 14, and 18, you'll see here, you had this rally here from 24 to 39. This is the K-Web, by the way. This is the one we're interested in because it holds BABA, JD, Tencent, etc. So this was a pretty big move from 24 to 39, over 50%. Then you had end of 14, you got another rally from 29 to 42. End of 2018, this was the beginning of a huge rally. First from 35 to 49, then 35 to 109. And then now right here, it looks like we've started to bottom. And we're up from 43 to 55 on the K-Web. And so it's the start of positive things. The other thing, I don't have the chart, but if you overlay commodity demand for metals in particular, on a lag basis, as this credit impulse goes down, the China demand for metals and the type of stuff that Rio Tinto and BHP Billiton mine can start to roll over as well. So that's another reason I couldn't get too excited about that from a China standpoint, but I could get excited on the China internet stocks at these valuations. So that's one more reason. The other thing that happened this week that was very important, that was not really covered in the news because there was noise again about the video game makers. There was an editorial in the official paper of the Chinese Communist Party focused on the numerous measures that China has taken in regards to regulations and matters that focus on antitrust and what China sees as unfair business practices. China also indicated in that editorial that the worst of the crackdown may be over, saying, quote, "The results have been achieved and the fair competition order in the market has been steadily improving." So Brendan Ahern, who's the chief investment officer of the KWEB ETF, said that I think it has been achieved as a key line that would indicate we're closer to the end. And he emphasized that in his note, which is called, so it was a front page editorial from the People's Daily newspaper. Intensified anti-monopoly supervision investigated and dealt with the monopoly and unfair competition behaviors of relative platform companies in accordance with the law and prevented the disorderly expansion of capital. The results have been achieved and the fair competition order in the market has been steadily improving. So in other words, they're saying we cracked down, we're seeing improvement in compliance, and it's kind of rear view mirror. You could, email me if you think there's another way to interpret that. But that's how I think it's playing out, and we'll see how that bears out in coming weeks and months. But that was a very positive thing. And then the second very positive thing was in terms of stock prices. I mean, if you want to talk about strategy and geopolitical debate, maybe not the best thing, but in terms of what it's going to do to the stock prices of these stocks, I think is positive. Biden called Xi last night over frustration with the dead-end talk. So he basically reached out and said, can we work together, et cetera, et cetera, et cetera. The market liked that, and the market viewed that as maybe a thawing of relations. So even in a heavy tape this week and today, all the China stocks were up. So here are a bunch of Chinese stocks. Baidu's up now. What is this? A weekly? 3 weeks in a row. Same thing with Baba, was up 0.5% today in a down tape. JD's up the last 3 weeks. They're all up in the last 3 weeks. So it looks like the bottom has been put in. You can always get retests, but I think this thing is starting to move. And all of them are making the same pattern. So that's positive. Okay. China's central bank turns to niche policy tool to boost growth. Relending facility offers more targeted credit support. So midweek, there was a sell-off, some related to the online, some related to that they weren't going to do the stimulus that everyone expected that they were going to do because they're worried about inflation. Then they came back out and said, well, we are going to do stimulus. It's just going to be different. I think when all is said and done, they're going to have to do stimulus, and that's also going to be supportive. So that will be another tailwind to the group. We covered that already. Oh, okay. This is an important chart of the 10-year note. And one of the things we like to look at is when the commercials, the green line, this is on the Commitment of Traders report, are buyers. They tend to buy ahead of moves up. So if this moves, 10-year note. So they're short-term buyers here, which could lead to kind of that short-term fake out we're talking about. So we'll see if this rolls over in coming weeks. But the other one that I want to show you guys and gals are some of these currencies, because on the Asia show, I was on CNA last week. They asked me about the dollar and about oil. And if you can see here, this is the euro. You can see the green commercials have been buying ahead of this move here from April to June. They were buyers, and the euro took off relative to the dollar. Same thing now. They've been buyers. So we think we could see continued strength in the euro, and that would be supported by the ECB announcing that they're going to start tapering. Although Lagarde said it isn't taper, it's effectively taper. I mean, they'll still be net adding liquidity into the system, but they're reducing the pace. So they're moving ahead, which would imply their currency will get stronger. And then if you look at the U.S. dollar here, what have commercials been doing? They've been selling them like crazy. So they're expecting a lot further weakness in the USD. So that would make sense if Europe is tightening ahead of us. It would stand to reason that the dollar would be weak against the euro and generally weak as a basket, and the commercials are set up for that, and you usually see that before peaks. So we'll see if we get continued weakness in the dollar in the short term. And right now we're moving right along to the article of the week. So this week we covered the AC/DC Thunderstruck stock market and sentiment results. And by the way, one other thing I wanted to just say about the emerging markets, this thing being near its lows before it took off last time, 9/11 in 2001, is the vast majority weighting now of the emerging markets is China. So the implication would be, if this is going to reverse like we believe it will, China would be the biggest beneficiary in that basket. But it's very interesting that both the small caps and emerging markets lined up at the exact particular time with very similar circumstances as well. So, okay, so we chose AC/DC's 1990 Billboard hit Thunderstruck to capture the current stock market sentiment. I'm not going to play it for you this week because the podcast people are going to get cut off in about 8 minutes. I want to get through this. But the bigger sell-off this week was predicated on the jobs report. We got a tremendous miss on Friday with the jobs report coming in at plus 235 versus plus 750,000 new jobs estimated. On the Cheddar appearance we did last week, Monday before the jobs report, we did say we expected the miss and that it would lead to a delay in taper implementation. As anticipated, lightning struck and the thunder followed, leading to 3 consecutive down days. Now it's been, I guess, 5 consecutive down days. And the lyrics here, yeah, thunderstruck, yeah, it's all right, we're doing fine. And I do believe that's going to be the case here. We're just in that seasonal time of year, but I think the type of stocks we've been talking about are set up to really have strong year ends. And we're going to talk about some of the triggers here. So as far as the show with Shauna, she asked some really good questions. So the first point I made was that taper impact is going to be the name of the game moving forward. The Fed has basically announced that they want to start taking the punch bowl away in Jackson Hole. But it's like the bartender at 2 a.m. who turns up the lights and says last call, but keeps serving drinks for the next 2 hours. I think that's the situation that we have now, and it's very similar to what happened on May 1st of 2013. At that meeting, Fed policymakers were coming around to the idea that June 18th or June 19th of 2013 meeting would be a good time to start tapering the bond purchases. And Powell was one of the big vocal advocates at that point when he was a voting member. And what actually happened was from the time that was known by the market, May 1st, that's what the Fed was thinking, you saw the 10-year yield move from 161 basis points to the next 4 policy meetings, by the way. So they had intended to start tapering in June of that year. Instead, they actually wound up starting the taper in December. They reduced the asset purchases to $75 billion from 75 billion to from 85 billion. So they reduced it $10 billion a month. But during that period, it was, in the case of bonds, sell the rumor, buy the news. So bond yields didn't go up after they started tapering. They went up in anticipation of the tapering after it was intimated that was the direction that they were headed. Now, they made it clear in Jackson Hole, and they intimated that that was the direction that they were headed, and they wanted to get it done before the end of the year if conditions permitted. Obviously, with the jobs report, that changed it. So September is off the table for an announcement. November is possibly on the table for an announcement. But if you go back to this, let's take a look at. So this was basically Jackson Hole. Yields have started to move up. The question is whether you get a similar move like we saw in 2013. And this chart we'll get into. But basically, May 1st is when they started intimating. And it's kind of an interesting setup. This is the 10-year yield right here. This was 161 basis points. That May meeting, they thought that June would be a good time to start the bond purchases. 10-year yield shot straight up from 161 basis points to more or less 3%, 300 basis points by that summer. And then over the fall, it kind of consolidated that. And by the time they actually tapered in December, it was back up to about 3%. And that was the peak of rates for the entire cycle. Rates didn't get that high again until 5 years later in 2018. So we could see something similar to that. And remember, they thought they were going to raise, they were going to taper, rather, not raise. They were going to taper in June, and it was 4 meetings later. And I could see a situation where they punt September, maybe they punt November, and then my early 2022, which I've been talking about for 6 months, proves to be correct, that they don't implement in 2021. They actually wind up implementing in 2022. And then does the 10-year yield, like you'd seen this, it was moving up, rolled over, and then it took off, moving up, rolled over. Do we take off in anticipation of that early 2022 taper? And if so, guess what happens? The same thing that happened. Remember, from the election to the first quarter, the reopening trade went through the roof. Banks, energy, industrials, all the defense stocks, just all did very, very well. And I think we could get a repeat of that if history rhymes, which I think it will be. And the key factor to make that start to rhyme soon, and whether we'll have any fake outs in the interim, I could see a fake out. I could see the kids going back to school, cases spike up for a week, everyone flips out. But as long as that 7-day keeps rolling over, I think this scenario could play out. And then not to 3%, because we're starting at a lower base, because we started down here at 50 basis points last year. They were starting from 139 basis points the year before. So let's just say, closer to 2% by the first quarter on the anticipation of taper, I think would be realistic. So we'll see. Now, let me just get to a couple other points here. So that was our base case with Shauna, was that by the end of the year, early next year, Q1, we could see the 10-year approaching 2%. And in that case, we want to have exposure to the reopening trades. The other thing was that everyone calling for a huge crash, like you saw these 6 big banks out saying we're going to correct 10 to 20%. You're not going to get that level of correction, certainly not anything close to 20% without a recession. And you get these big crashes after the yield curve inverts. 2-10 spread drops below 1, like you saw last summer, 6 months before before we rolled over, and like you saw in 2007, and like you saw in 2000. You get this signal. We're the farthest we could possibly be. We're in the early stages here of steepening. And it usually, goes in the case of 2003 and 2004, that lasted about a year and a half. We're only about kind of a half a year here in the steepening part. And then you got all this part where it compresses for years before it inverts. And that's the sweet spot of the bull market. So we're not even close to that. We haven't even started coming towards inversion. We're still way up here. So, that's that. By the way, if you're on the podcast, you're going to get cut off. Just go to hedgefundtips.com. It'll all be right there. Okay, so a lot of stuff we're covering this week. I hope you guys are finding it of great value here. All right, so that's the key for the recession and the big crashes. So there's no reason, in my view, to be overly concerned about big crashes. Normal pullbacks are a dime a dozen, 3 to 5%. That's realistic. And that's that. So on the reopening trades, the other thing we pointed to was also very hard to get a major pullback because earnings are underpinning the acceleration of the market. So a handful of months ago, they were at $200 for the S&P in 2022. Now they're at 220. We said we thought they'd go to 230. We think they'll be there by the end of the year. And at that level, with this multiple, you could get a little multiple contraction, but it's reasonable to get to 5,000 on the S&P inside of 12 months with that type of earnings power and that type of multiple. So unless something were to really dramatically get impaired as it relates to earnings, it's unlikely that these scenarios that the big six banks were talking about would come to pass. So the three trades we laid out to Shauna on Yahoo Finance were Boeing. We love Boeing as a reopening trade. The 737 MAX was approved to fly a week and a half ago in India. The big catalyst next is going to be China. And my guess is the phone call with Biden last night had something to do with that. On that basis, you've seen Airbus is up, 28, 29% year to date. Boeing's up probably 1% year to date. We think that's going to converge with the approval of China on the 737 MAX to fly again, like you've seen in many other countries. And that will be a huge catalyst for Boeing. And we think Boeing is a $300+ stock over the next 12 to 18 months. Second is, and that's all in line with the defense stocks, with Lydia Moynihan's article, with everything we've been talking about. They all sync to this exact thing. Rates starting to creep up. Cigna, we went through, trading at 9.5 times next year's earnings. We know about the medical care ratio. We know the pharmacy business is growing. We think this works back up to new highs in the next 6 to 12 months. And then EOG, we want to get some high quality exposure to energy as that demand comes back for travel, trading at 8.5 times next year's earnings compared with its historic multiple of 20, pays a 2.5% dividend while you wait. It's the most technically proficient operator in the business, and their assets are in the Permian and Eagle Ford. So that was that. The China thing you can watch on your own. That wasn't China, that was Singapore. And then sentiment this week was mixed. It's neutral. It's right in the middle. That's why we're just grinding sideways. And then here's another chart from Ryan Dietrich. Good start to 2021 could mean a strong finish. If the S&P is up 20% or more through August, the rest of the year tends to be positive, on average up 4%. And as we said last week, while everyone debates whether we're going to have a September swoon or not, take a step back and look for the stocks and sectors that have already had a summer swoon. We just went through it. Some of the airlines, some of the defense and aerospace stocks, which are tied together. Some of these reopening trades, they've all been on hold, and many of them have swooned 20 or 30%. There's the opportunity. So the lightning came on Friday, the thunder followed, and we believe the sunshine may show up in places where few are looking of late. So that's the story there. Some more Boeing options, unusual option activity in Boeing earlier in the week. Here are 2022 estimates, 219.83. They continue to creep up every week. We'll see more of that as we're kind of in a dull period now with earnings being over, but in the next few weeks it'll ramp up again. And then finally, the economic data for the week. JOLTS 10.9 million job openings. That was pretty impressive. Now we get to see if Chair Powell's thesis plays out, that as the extended unemployment benefits roll off, and a new supply of labor comes back on the market, do wages start to level out and stop going up? And do we fill the gap? We had 5.7 million people unemployed February of 2020 before the pandemic, 3.5% unemployment rate. We're now at 5.2% unemployment rate, and we still have 8.4 million people. So getting that last, 2.7 million people, we'll see if they start to fill these jobs. Continuing jobless claims was weak again this week. It missed expectations, but initial was strong. Initial jobless claims came in better than expected, 310 versus 335. We did have a draw in crude of 1.5 million barrels. That was less than expected, and because travel will go down short term. But the minute that 7-day average continues to roll over, the market will look through that and start to discount the demand picking up again. And then inflation numbers were a little hot. So the PPI came in at 0.7% month on month versus 0.6% estimated. And year on year up 8.3% versus 8.2% estimated. So that, these numbers, and same thing with core PPI, that puts a little pressure on the Fed. So on the one hand, they had this horrible jobs report. They've got this Delta overhang. On the other hand, the inflation numbers are running hot, but they're betting that with the unemployment benefits rolling off, that supply of labor will put some pressure on things. So we'll know more. Certainly, the October report, the September report, which is the first Friday of October, and more clearly the October report, which will be the first Friday in November. So we'll look forward to that, and I'm sure the Fed will, and those will be the critical pieces before the November meeting, whether they announce right away and say we're going to start tapering in December like they did in 2013, or they punt four meetings rather, like they did in 2013, then we're looking at early 2022, and that's our base case. So with that said, a lot of great questions that we were able to cover, a lot of great themes that we could drill down on a bit more this week, and we'll be back next week, same time, same place, for our 100th episode. Who would have thought? That is absolutely incredible. Thanks for listening in this week. In the meantime, make it a great one. We'll talk to you soon.